Welcome to the weekly update, where we'll go over the action in the market for the previous week, June 27th through July 1st, and then see how things look for July 5th through the 8th. And it ended up being a pretty negative week overall, not just because we were down a little over 2%, but mostly because the first half of the year has been very, very difficult. In fact, some people are comparing it to other years just to try to make the point a little more drastic. But we'll go through and look at things. We're still pretty much negative overall, and you'll be hearing me say a lot of the same things again in this week's video, just saying, okay, recent death cross and we're in a downtrend. You'll hear that over and over. But let's go back and talk about the week. We had another losing week after a terrible first half. And that's what I'm hearing a lot of people doing, is just saying, okay, well, there's the first half of 2022. Let's see if the second half will be any better, because sometimes that ends up happening. So we'll just follow the charts and see how things look on a day in and day out and week in, week out basis. There's a lot of concerns about economic growth. We're seeing some slowdown in the reports that are coming out, and some of them are even suggesting that we're going to head into a recession. We're also worried about earnings, because as interest rates go up and as economic growth slows down, companies tend to earn less, which eventually feeds through to their bottom line. Inflation is really going up, and a lot of people are worried about being in a stagflation environment where we have very high inflation, but no real economic growth. And then everybody's really focused on not only the Fed in the US, but the central banks around the world. Are they going to keep raising interest rates? What's going to happen here? Bonds rose this past week as interest rates declined, so they're starting to see some weakness in the economy. If they thought the economy was going too hot, interest rates would keep going up. But that's not necessarily what the bond market is seeing right now. Now, that could always change, but that's what they seem to be concluding right now. A lot of disappointing economic data that shows growth is down and inflation is up. And the GDP this past week was revised down, which is adding to the recession fears that everyone seems to be having. Please be reminded, although I'm recording this video a little later than usual, and you might already realize this, but the markets will be closed on Monday for Independence Day or the 4th of July, whichever way you choose to describe it. So for the week, we were down 2.21%. Volume was below average, which we're getting into summer now. You have a lot of people that really don't know what to do. They're waiting to see, are we going to continue to go lower? They don't want to be in the market if they only do long positions. And people that do short positions, it's like, wait a minute, we have all these signals that are telling us that we might get some kind of a bounce. And so you have people that are kind of frozen right now with deciding what to do. The fixation on the technicals, we're negative overall. There's really no way to go around that. We're negative on the daily charts as well, and that's feeding over into the weekly charts. Inflation and interest rates, as well as growth concerns, are the big problems or focus points right now. We have just a list of geopolitical concerns that could come into play at any time, depending on what happens, either in a positive or negative way. And then things going on in China with the supply chain issues. My understanding is that they're lessening the lockdowns. They haven't found any new COVID cases, at least in the last report I read. And so that might be lessening a little bit, and that could help things. Oil is just bouncing all over as it's still above 100. We have Fed speak and policy. They still tend to be more hawkish with their stance on things. And we heard some things over the past week, just saying that inflation is their main concern, even if it bleeds over into the economy and hurts that. So they want to try to get inflation under control. And then a lot of recession fears and debates that are going back and forth. Some think we're already in a recession now. Others think that a recession will happen soon. Still others think, no, we'll probably be able to avoid the recession. Our trend is strengthening and still negative. The ADX continues to advance with the red line on top, and I'll show you a chart of that. So we can't really go against that. So here is the week right about in the middle, where we a little bit over to the left, where we were pretty flat on Monday. We gapped higher on Tuesday, only to give all that and then more back, and ended up closing right at the low. This was the real kind of negative day that set the tone. We ended up being pretty flat again on Wednesday. We gapped lower on Thursday, and this was kind of impressive. After gapping lower, we saw a pretty good comeback. Didn't really do anything to the daily charts or even the weekly charts, but this showed a little bit of strength coming in, but then we ended up giving some of that back, a lot of it. Then on Friday, that was the more positive day of the week, where we gapped a little bit higher, went lower, and then near the end of the day, we did shoot up a little bit and closed right near the high. So for the week, the Dow was down 1.3%. It's been holding up better than other indexes. The NASDAQ really got hit. It was down 4.1%. The S&P was down 2.21%, and the small caps were down 2%. And here, just looking back the last 5 trading days, just shows how the Dow did the best and the NASDAQ did the worst. And here, with our different sectors, the discretionary, they've been getting just beat up all year. Well, this previous week showed pretty much the same thing. And the tech sector was down 4.5%, and communication down 3.72%. The two areas that did pretty good are the areas that have been doing good, more the value areas or defensive stocks. Staples were up 0.5%, energy was up 1.38%, and utilities, which did better earlier in the year, saw some recent weakness, but now seem to be bouncing back a little bit, at least right now. They were up 4.12%. And this just shows the different sectors over the last week, showing how utilities and staples are the ones that are more in the lead. Energy was down on the week, but still has been the best performing sector overall, with tech and discretionary really getting hit hard. Looking at current market valuation, they still have us at fairly valued, and they change things out there. So I only bring up a couple of charts that seem to be most relevant to us, looking at the S&P, where we're still 43% above the historical average for the S&P. That's what the zero line is here. And when we get too far away, we have a tendency to come back. And even though we're not as far away as we were, we're still pretty far away overall. And then this is showing how the historic trend line has been going up. And as of July 1st, the S&P is 31% above its trend line right here. And this is inflation adjusted. So this tries to take that into account. So we're still a bit overvalued when it comes to this chart on a valuation basis. Sentiment after Friday's session, we're back down into extreme fear again. And here is the chart to show things overall. But we camped out here for a long time, mainly through the spring and into May. And so just because we come down into this area right now doesn't necessarily mean that we'll see a bounce. We're not seeing any kind of critical mass or a V shape out of this extreme reading. The spread between the risky bonds and the not so risky bonds, it's still going up, but it's not necessarily that extreme yet. The RIDEX bear bull ratio actually bounced up a little bit to 0.10 in the latest reading. So folks are kind of, some are in bearish funds, some are in bullish funds. The AAII weekly survey shows that individual investors are still extreme negative, but they've been that way now for a few weeks, and it really hasn't produced any kind of a bounce, since we tend to use this as a contrary indicator. Here's some charts from IsabelNet where this just shows inflows and outflows. Well, here, the dark blue line, that's bonds and how people have really been taking their money out of bonds. Could that suggest some kind of capitulation in the bond market? Right now, kind of the scenario I've been going with is if bonds can find some support and start to go higher based on price, that'll bring interest rates down, and that might feed over into the stock market and help give it some support. Until we see that, we've got a lot of headwinds that we're dealing with in the stock market. This is showing ISM. This is an important economic report that comes out, and it is the gold or orange line here where it's really been decreasing, where we have the S&P 500 on a year-over-year basis. It's really been declining as well. These two tend to go hand in hand with each other. Then this is another thing that's kind of interesting. I love it when people go back and say, this is the biggest since 1980 or the biggest since 1783 or something like that. Well, commodities are on their best course. These are where we get a lot of our inflation readings from. And they're on their best year since 1946. And we have a lot of different events that happen. We haven't really had a major event as far as, yeah, there's Russia, Ukraine. Yeah, there's the lockdowns continuing in China. But is that big? Is that big enough? Is the market telling us that something bigger might even happen? Because look at some of these other events when commodities really spiked. We had World War I. Of course, that was kind of a big deal. We had the New Deal. This is during the Depression in the 1930s. World War II, that was kind of a big deal, as well as the Korean War. We had the Yom Kippur War. That was 1973. And that produced a lot of the gas crunch that we saw back in the 70s. And then in 79, when we were having trouble with Iran, that produced another oil shock. And then, of course, 9/11 didn't really see a big spike up at that point. But what is this telling us? Because sometimes the market, in fact, all the times, the market is a leading indicator. But what is it leading us by telling us? Is there some kind of an event? So we'll just have to see. I hope not. I hope it's just the fact that things are kind of weird in the economy and it kind of stays within the economy and then will eventually work itself out. But it could bring a lot of pain in the process. The Fed funds target rate, according to Goldman Sachs, they see it really climbing up and then eventually dropping off. This is what the futures markets are telling us right now. So their forecast is for 2024 to be around 3.4%. This is Bank of America, and this is their global wealth management program. And it's just showing that most of their folks are into cash right now. They're going above this blue line and they don't really know what to do either. So they're just deciding, okay, the dollar seems to be holding up for right now. So let's go ahead and stay in cash. Then these are folks that use the leveraged ETFs. And this is what we use as part of the program that I teach, where the black line is the S&P 500 and the red line is just showing the ratio between long ETFs, either 1-for-1 or juiced ETFs, or are we in short ETFs where you can make money when the market goes down? And they're very heavily weighted over to the short ETFs. So can we use this as a contrary indicator? If you look back at other times when we had an extreme reading, this often marked the bottom in the market, but we're just not seeing that yet. We're seeing a lot of these marking a bottom type of signals in 2022, but they're not really leading to anything. And here's the divergence between gold, which has really been doing nothing, which in this kind of an environment, you would think gold would really shine, no pun intended there, but it's really not doing all that much. It's supposed to go up when inflation is really going up, but it's really just not doing that right now. So here's the price of gold, which is the dark blue line, and here is the 10-year real rate. That's taking inflation into account. And it just shows when you compare gold to the real rate of inflation, it's really been declining overall. Here's the VIX, which showed we had a bit of a decline, even though we had a down week, both based on the line chart and the bar chart. The Ulcer Index continues to go up on the weekly chart, where it's been really coming down on the daily charts. Here's the Chicago Fed National Financial Conditions Index, where this is starting to get up, and we're getting a little close to this black line, but we're not there yet. And you can see back other times when we climbed above that, that usually meant some kind of difficulty economically. The latest reading for the active asset managers shows that we had an extreme negative reading, but we bounced up off of that. We're at 30.66, which is still extreme negative, but it is showing an improvement based on the week before. We were below 20 in the previous week. Our insider transaction ratio is getting up more around the neutral area right now. It is coming up. There are people that are buying stock that work in these companies, but until we get to a kind of a high reading, we're more in neutral land right now. Copper has been interesting lately. We're really seeing that fall, and we call it Dr. Copper, because if copper starts to go up, that generally means that the economy will improve in the future. If copper starts to go down, that means that there may be some weakness in the economy. So we're just keeping an eye on this as this continues to drop. This daily scenario just doesn't seem to really be happening right now. We had the VIX spike up and then come down, and then a lot of times that marked a low on the daily chart here of the S&P, but we're not seeing any follow through with price, at least yet. And our ratios that could have been suggesting that rotation is going on, well, that seems to be breaking down right now as well. The Qs are really falling off. The discretionary, it turned up a little bit, but it's below the moving average, and the large cap to value to growth is pretty much flat. And then looking at the different large, mid, and small cap growth value ratios, we're falling off a little bit or going flat overall. So this just doesn't seem to be playing out, at least yet. We'll have to see. Will it pick up starting in the second half of 2022? The Shiller PE ratio still has us very overvalued historically, where the median and the mean are between 16 and 17. Well, we're just under 30 right now at 29.55. So this is suggesting that the market is still overvalued. And then this is a FactSet blog post showing that, and this is kind of some of the game that's going on right now. Analysts lowered the EPS estimates for the second quarter of 2022, but they raised their EPS estimates for the current year, 2022, during the second quarter. So what's going on here? They should be lowering their estimates, and they did for what's happening right now, but they're still looking out into the future and having more of a positive picture. And so it doesn't really help us all that much. Are earnings going to go up or down? Is there manipulation going on here? Or do they see things that we're not necessarily seeing right now that are looking more positive that will help companies to earn more in the future? These are the current estimates with Morgan Stanley and the consensus, just showing how Morgan Stanley is still underneath. And they're raising it. Here's the 2022 estimate and 2023. So it is over from 225 to 236, or it is climbing. But I don't know, we're just not really seeing that yet. Then we have the GDP, which the Nowcast put out by the St. Louis Fed. It's showing that we have a GDP of 3.89%. That's what they're basing things on right now. But if you look at on Friday, we had the Atlanta GDP Now forecast come out, and they actually revised this down to over 2% decline for the GDP. FedWatch, at the meeting coming up at the end of July, there's an 82.6% chance that we'll be at 2.25 to 2.5. We're at 1.5 to 1.75 right now. So this would be another 75 basis points or 0.75%. And here is the September meeting showing that there's a 70% chance that we will be at 2 3/4 to 3%. And that's where a lot of folks think that the Fed funds will top out, is at 3%. And that's pretty much what the Fed has led us to believe right now. But that could always change as economic reports and as things happen. Here is the Fed balance sheet showing that it actually turned up just a little bit in the previous week. Looking at breadth, we are negative overall based on price and volume, even though it bounced up slightly. The advanced decline ratio is more positive and actually advancing, seeing a little hope there. The new highs and new lows are still negative, but trying to bounce. Accumulation distribution still remains underneath the 200-day moving average, so that's negative. Our trend shows the ADX continuing to climb, even though the red line came down and the green line was more flattish. We're still seeing an increase in the trend on the weekly charts. And our Arun is really not getting any more positive. It's showing the sellers are in control, buyers are really falling off. So when you compare the two, we are negative, even though we were flat in the latest reading compared to a week ago. The mass index is just not giving us a signal right now. Some other charts, our pivot points, we're below S1 for the month. And can we get back up here? That's kind of the thing. We're kind of in no man's land right now as far as the pivot points are concerned. We're below the 50-period moving average, and the trend is down with the death cross and below the moving averages. Bullish percent index actually increased a little bit, but closed near the bottom part of the range for the week. Jacobs oscillator giving us a little bit of a positive reading right now after being extreme negative. Jacobs money flow is still negative, but showing some improvement. The force index declined a little bit in the previous week. McClellan oscillator still positive because it's above zero, but did decline. And the summation index is trying to bounce up a little bit based on price and volume. All of our oscillators continue to be negative overall. And here's the PMO, one of those oscillators. We're negative based on price and volume. The percent of PMOs that are rising after giving us an extreme positive reading has now come back down. The buy signals continue to advance, and the PMOs that are above zero is trying to turn back up. The RSI declined recently. Special K is still positive, but continues to roll over. The Swinland trading oscillator is slightly negative based on price and volume. The Stoke RSI declined in the previous week, as did the Williams percent R. Our Vortex indicator is negative also. We see an increase in the selling and a decrease in the buying. Ultimate oscillator also declined. The money flow indicator was up ever so slightly. The Bollinger Bands actually declined a little bit in the previous week. The KST continues to be in a downtrend, as is the PPO. And the rate of change going back 1 week, we're pretty much neutral right now. Going back 50 weeks after giving us an extreme negative reading is trying to bounce up, but ticked down slightly in the previous week. The Copic curve really isn't giving us a signal. We do have a signal on the daily charts, and it's starting to turn up, but we don't really know the direction that the market will go if that signal is really followed. But we're continuing to decline on the weekly chart. And then we're still above this 38.2% retracement. That's positive. And this green line is the 200-week moving average. And it's right about at the 50% Fibonacci retracement. So that could offer some pretty solid support down below if prices fall. Our different charts, the Heiken Ashi is giving us pretty much a doji right now. It opened and closed at the same place. The Kegi is still negative overall since it's red. The Renko is also negative. The ease of movement declined over the previous week. And even though we don't have a signal with the point and figure weekly chart, we did see 3 new circles drawn in, and circles are negative where X's are positive. The 3-line break continues to be negative. Our different trading systems, the elder impulse is still neutral. The parabolic SAR continues to be negative, where on the daily charts, it switched over to positive. In the broad market here, just the 3 main indexes that we follow, the S&P, the mid caps, and the small caps. The all stocks are still in a downtrend and actually declined a bit in the previous week. Now here's where you're going to hear my broken record. Death cross below the moving averages with the mid caps, small caps, and the Dow, as well as the NASDAQ and the NASDAQ 100 and the NYSE and the Wilshire and the FANG stocks and ARC, which was down over 10%. Still having a hard time with ARC getting above this moving average. It seems to be acting as resistance. And the dynamic software index is in a decided downtrend. Looking at Dow theory, just showing how the Dow has been having some trouble. The transports and the utilities, see how they spiked up a little bit in the previous week. The CRB is kind of getting hit right here, even though it's the best year since 1945 or something. It is showing some recent weakness overall, but the uptrend is still intact. Gold, which has just not been doing very much. Silver has been having a lot more trouble, where it's been falling off lately. Oil, right around the 108 level overall. And the dollar, it's been doing about the best. It's up on the weekly chart and doing better compared to the Japanese yen and the euro. Looking at bonds, we were up slightly in this past week, but we could be hitting resistance at this moving average. The treasury yield is really starting to come down. We broke above this resistance level only to come back down, and now we're pretty much below that. And here's another chart showing how that happened, where we are coming back down below 3% now. And this just shows how rates have been falling recently. And here's internationally, looking across the board, where Japan still is trying to keep things really flat because of their problems that they're having there. But we saw a real decline in this past week. Relative studies, bonds are starting to outperform stocks a little bit, but bonds have been so beat up. We'll have to see, can they get some more positive action going on here? And we're almost ready to see a cross with this chart. On a monthly basis, stocks which had broken out and were doing better on a relative basis are starting to come back down. Intermarket analysis, oil is up the best, or the most, I should say, with the dollar coming in second. Gold is actually starting to turn negative now, where stocks and bonds are negative and trying to turn back up slightly. The gold to the US dollar ratio, since gold's doing nothing and the dollar's been doing the best, this ratio is really going down. And here's the gold to the S&P, where gold is still outperforming. And that's not because gold is doing great. It's because the S&P has been really struggling. And here's the low volatility stocks, which are really breaking out again compared to the S&P. Here's the growth to value ratio, just showing how growth has really been underperforming value. We thought that was beginning to change, but it doesn't look like it's doing that right now. The NASDAQ 100, another growth index, it's really underperforming the S&P. And the S&P 100, again, more growth in the S&P 100, it declined compared to the S&P 500. Discretionary is really having a lot of trouble against staples right now. And energy kind of ticked back up over this previous week after really having some weakness compared to tech. So what's our outlook? On Tuesday, we have factory orders coming out. On Wednesday is the ISM non-manufacturing index. We had the manufacturing index on Friday. So, and these are pretty important. We want to keep an eye on these. And we have the FOMC meeting minutes that will be coming out on Wednesday to try to read any secret meaning into what happened. On Thursday, we have the ADP employment change, not a big one, and jobless claims. That's not too big of a day economically. Friday, we'll have the employment situation report, and that will be a big deal, as well as consumer credit. So we're watching all the things that I've been talking about, the technicals, which are negative, inflation, interest rates, any of the geopolitical concerns, specifically Russia, Ukraine, China in the supply chain. Is that going to start improving now? Oil as it's bouncing around, any Fed speak that we end up getting, earnings as they're released by each company, and the situation in Japan. And then if we start to fall, are people going to keep getting margin calls because they use borrowed money to buy things? And if that starts to erode, they have to pay that back and they have to sell whether they want to or not. So our scenarios, we are still down overall because of all the things that I just mentioned, and the technicals are still pretty negative. So that's the path of least resistance right now. What could turn things around? We need the technicals to really improve. And there is a real disbelief that the market's going to go up. And sometimes it's like when nobody believes it, that's when it happens. And our possible positive scenarios, we're just not seeing those right now. We need those to improve to show us that maybe some rotation is going on. Maybe some growth is finding some interest again, but that's just not happening right now. In our technicals, we're watching all the different pivot levels, the fib retracements, and then previous highs and lows, which may provide support or resistance. We're not sideways right now, so we are in a negative trend. So thank you. Have a very good week. I took a little bit of extra time to do this. I wanted to actually have a little bit of a 4th of July celebration myself. So have a very good week, and I'll prepare the next video after Friday's session.